This futures hedging example uses stock index futures. Remember that market risk, also referred to as systematic risk, is measured by beta. And also remember that the beta of the market is 1. And we typically proxy the market index, the market portfolio that is, using a well-diversified stock index such as the S&P 500. And so what all this means is if you wish to hedge a stock portfolio with a beta of less than 1, you're going to have to need less futures contracts to hedge it. Conversely, if your stock portfolio's beta is greater than 1, then you will need more futures contracts, since the volatility of such a portfolio relative to that of the market is greater. So to account for the degree of a stock portfolio systematic risk when constructing a hedge, the hedge ratio shown here would have to be adjusted by its beta, as you can see. So what this does therefore is, if the beta of the portfolio you're managing is 1, in that that portfolio is just as risky as the market, then this hedge ratio collapses to the traditional hedge ratio of S over F, the spot divided by the futures contract, all right, which is the value of your stock portfolio, the current value that is, divided by the price of one stock index futures contract. So a quick example, say you're managing a portfolio valued currently at $95 million, and that portfolio systematic risk, well, beta is zero point 0.9, meaning that this portfolio is slightly less than the market, less than that of the market. Now, afraid that things might go sour in the future in the stock market, you decide to sell futures uh, and in a short hedge. So right now, the futures price of the maturity contract you're looking at is currently 35.10. And remember, contract size for S&P futures contracts is $250, and so the futures contract price would be the product of these two numbers, which comes out to be 877,500. Now you construct your hedge ratio S over F adjusted by beta, it comes out to 98, and you can see the calculation right here. Remember, your hedge ratio has to be a rounded whole number, right? Contracts sell in whole numbers. All right. So now, let's say that the market declines by 5%. Now, what this means is, remember, your portfolio's beta is 0.9, so your portfolio is only 90% as volatile as the market. And that means that you can expect your portfolio to go down by about 4.5% from $95 million going back here to 90.725 million, a loss of 4.275 million. So that is sure to put a sad face on you, as you can see right here, as a result of this loss. But now hold your fire though, because we need to check out what's happening in the futures department, because right here you're going to have to offset your futures contract, meaning if I go back here, you sold futures, and to offset you're going to have to do the opposite. You're going to have to buy futures. Now again, remember, the market went down by 5%, so that means that your futures price, that the futures price is going to go down from, I go back here, 35.10 to 33.35. All right, that represents a 5% decline multiplied by the contract size of $250. That gives you a futures contract price of 833,625, which is the product of these two numbers. So what is this telling us? Well, I see a good thing right here happening for you, because as you can see, you sold futures for 35.10, and now you're buying it back for 33.35, and adjusted by the contract size, you are enjoying a gain of 43,875, which, as you can see, is the difference between the price at which you sold futures and now the price at which you are buying it back. So that's how you look at this. You sold futures at a price greater than you're buying it back. The difference of 43,875 represents your gain per contract multiplied by the total number of contracts in play, which is 98. Your total gain here is 4,299,750. Now then, that gives you a smiley face right there. And as you can see, a sad face and a smiley face. You're good by a positive difference of 24,750 because your gain on the futures is greater than the loss you incurred on the spot position. And so this is not a perfect hedge, but it's a desired outcome nonetheless. And I hope you get that.